Take a look at this chart right now. Whenever the green and then the blue line comes into an agreement in an uptrend, whenever the blue line goes below the green and then the market comes to touch the green perfectly, there's always a high buying momentum. We can see it here, right here, here again, and then we also have it here again. And also in a bearish market, whenever the green goes below the blue and then the market comes to tap it perfectly in a close range like this, there's always a heavy selling momentum. We had it here, we had it here again, and right now it's about switching to the other direction. And the truth is that what this isn't a coincidence. It's actually the help of the exponential moving average. And in this video, I'm going to share with you every single thing you need to know about the moving average and how you can use it to actually get good entries. Moving average has gotten a lot of bad reputation over the years in so many trading circles, as most traders say they are slow, laggy, this and that. And that's 100% true. Moving average are actually laggy, and then they don't tell you what will happen in the market in the future. But one thing that a lot of traders has kept out of the picture during this whole time of criticizing the moving average is the fact that the moving average was never meant to predict the future for traders. It was basically meant for three simple things. And the first one is simply it was meant for you to actually identify the market trend. And secondly, it was meant to actually act as a dynamic support or resistance level. And finally, it was meant to actually act as an entry filter to help you avoid bad trade. Not 100%, but at least 80 to 90% of the time. But then so many unprofessional traders try to use it as their main strategy and end up giving it a bad reputation. That's why in this video, I'm going to walk you through the exact moving average settings that you need and how you can actually go about trading the moving average profitably, and you can actually align it with any trading strategy that you are currently trading. And this video is actually brought to you by Light Finance. Now, Light Finance is my preferred broker that I personally recommend for every trader out there to actually sign up and trade with. They have fast trade execution, and then they also have copy trading, which makes it easy for unprofessional traders to actually make money off the market without having to stress themselves. What this basically means is simply you can copy other profitable traders on the platform without you having to analyze the market or do any single thing. And they have some of the most competitive spread, ranging from 0.0 for some trading pairs up to just $1 or 10, regardless of the lot you are actually trading. So basically, if you are looking for a reliable broker to actually trade with, I advise you trade with Light Finance. They are the best that I would personally recommend to anyone who is getting started. So now the link will be available in the video description. Now, if you are watching on Facebook or TikTok, then check the link in my bio or in the pin comment. Now, I'm going to break this video into 4 major sections. Now, the reason I'm breaking it down so that every single beginner can get along and understand it chapter by chapter. So here's what we are going to do. For the first chapter, we are going to talk about the period that actually matters when it comes to trading moving average. And secondly, we'll talk about the dynamic nature of moving average when we are using them as a dynamic support or resistance levels. And thirdly, we'll talk about the MA crossover strategy, which is the moving average crossover strategy that I shared with you in the intro of this particular video. And I will also share with you the final session, which is how you can actually use this alongside your trading strategy to filter out bad trade and only end up with some good trade. Maybe at least give yourself a 70 to 80% win ratio of a 1:2 or 1:3, which will make you a profitable trader. Now, talking of the periods that matters when it comes to trading the moving average, there are only 3 periods that actually matters when you are trading the moving average. Now, the first one is basically the 20 moving average exponential. Now, I don't use a simple moving average, I use the moving average exponential. So the first period that actually matters is the 20 moving average. Now, the 20 is actually meant for short-term purpose. So basically, if you are someone who takes short-term trades, you don't want to hold any trade for too long, or you don't care about the bigger picture of the market, you just need something short and reasonable, then the 20 is the best option for you. So the 20 give you short-term trading opportunities, unlike the rest. Now, the second period that actually matters is actually the 50 period. So I'll add another, which is a 50 period moving average. Now, the 50, unlike the 20, the 50 give you the medium-term moving average. It tells you a bit bigger picture as compared to that of the 50. So I'm going to, as compared to that of the 20, so I'll keep the 50 as blue so that you can actually identify it on the chart. And then the third one that actually matters is the 200 moving average. Now, the 200 actually gives you a way bigger picture. I would say it gives you the overall picture of the market that you need as a trader. So basically, we have this 3 moving average that actually matters. Any other moving average other than these 3 doesn't really count. It's just an opportunity for you to waste space in your chart. So if you are a trader, these are the only 3 moving averages that you should pay attention to: the 200 period, the 50, and then the 20. The 20 for short term, the 50 for medium term, and then the 200 for long term opportunities. Now, talking about the dynamic nature, whereby the moving average is used as a dynamic level of support and resistance. Here is a typical example. Like in this video here that I actually uploaded here, I actually walk you through how I made $2,500 just from trading basic support and resistance. Now in this particular video, I actually shared how you can trade a static support and resistance level. Now the difference between a static support and resistance level is that what? A static level is basically the horizontal level whereby you just mark on the chart. Like for example, someone who is trading support and resistance on the static level is going to mark here as his new support level. After the market took out here, this high here becomes its new support level. Now this is for someone who is trading a static support and resistance. But in a situation whereby you are using the dynamic support and resistance, whereby we use the 50 moving average as a typical example, because that is the one a lot of traders actually use, people no longer wait for the market to actually come back to this static support level, this static resistance level that tend to support, in order for them to take their trade, but they wait for the market to actually come back to test the moving average. Now the reason why the dynamic moving average is very helpful is that, well, when you are trading support and resistance, and then you are in a very serious uptrend market like this one here, whereby the market is moving continuously to the upside, and you are not sure of when next this market is actually going to trace down, well, with a 50 moving average, you no longer have to wait for the market to come back to the old support and resistance level that you might have drawn behind here like this, that you might have kept behind here. You no longer have to wait for them. What you wait for is basically wait for the market to actually trade, and then trace back to this 50 moving average that you have on your chart. Like in this situation right now, I'm using the 50 moving average. So instead of waiting for this market to trade from here back here before I will say, okay, the market has come back to my support level, let me look for buy, let me look for sell. No, I no longer do that. All I need is basically I wait for the market to trade back and then touch the 50 moving average at a new point whereby the moving average is heading to. Once it gets to it, then I can basically say, okay, the market has come back into my buy level, which is my new support level, and I can actually buy from there. Now talking of the MA cross, now the MA cross is one of the most popular moving average trading strategies. This is because I would say it's the most beginner friendly strategy ever. However, most beginners still don't take their time to actually study it, back test it well before actually using it. So the MA cross is basically simple. When a short period moving average crosses above a longer period moving average, it tells you that, okay, the long term period, this is the market trend, and then the short term period, this is the market trend. Now basically, let me show you a typical example of it. Now for example, let me say you're a higher time frame trader, and then you have the 200 moving average in this manner. Now you can see with the 200 moving average, at this point here, what? The 200 moving average is well below the 50. You can see the 50 is the blue one, so the 50 is sitting right above the 200. So this tells you that what? The market is actually in an uptrend. Like the 200 has informed you that the market is an uptrend. Meanwhile, the 50 has signaled you to actually take your entry. So when the 50 goes above the 200, it means that what? Okay, the market has switched into an uptrend, and I'm here to give you your confirmation. So basically for me, I would say the short-term moving average acts as a confirmation to the long-term moving average. So if the long period is going to the upside and then the short one eventually crosses above it, it means that what? You can actually buy. But if the long one is going downwards and then the short one is going upward, it means it's a very confused market. And for me, I would say the 50 and the 20 combined is actually more accurate than the 50 and 200. To me, that is basically what I'll tell you based on my own backtesting record. Now here, take a look at it here. Now in this situation here, the 50 tells us the overall market trend. So the 50 tells us that what? The market is trending to the upside. Meanwhile, the 20 tells us that what? Okay, we can actually look for a trading opportunity. Like take a look at this situation here whereby the 50 is down and then the 20 comes above it. This here becomes your entry, and then you can just take your trade immediately. Now here is one thing. When you are looking at it in the real market, you are actually not going to spot where this thing happened. Before the 20 is going to cross above the 50, this bullish candle here has already been printed or already far gone. This is why a lot of traders says that what? The moving average actually lags, and that is the big truth. In most situations, this big candle will be formed already before the 20 moving average will actually come on top the 50. So that's why I personally advise that what you use them as direction and not actually entry. Now this is the most popular moving average strategy that a lot of people have taught you. This is why a lot of you keep failing. You learn it and then use it to trade, but my advice is simply don't learn it and use it to trade, but learn it and use it as a directional guidance. Because now let me just go back. This is a backtesting software, so now let me show you real quick. Now let me cut this market back to this particular point here. Now take a look at this point here. You can see that 50 is above, is at the top, and then the 20 is down, which actually signifies a bearish market. Now let's take a look at what happens. Now let me play it one after the other. Now let me just play it so you see. Take a look. You see the bull, this big candle already formed fully before the green one came above to actually tell you that what you can actually buy. So what does this mean? This means that what you can't actually trade this moving average profitably in most situations when you rely on only two of them. Because for example, this bullish candle has already been formed. So where are you going to take your buy setup from? Are you going to buy from here? Are you going to take your buy from here and keep your stop loss below here? It doesn't make any sense. Even though the market might, okay, it might play out in some situation, but then it doesn't make any sense. Look at how far you need this market to trade before you actually get a simple 1:2, which might actually happen and might not happen, but then it's not worth it. This is why I personally advise that what you use it as a way to actually say, okay, this market is trading to the upside, so let me look for buying opportunity, or this market is going to the downside, let me use it as a selling opportunity. So now I just bust the greatest information going around the moving average strategy, which I tell you that what it works, but in most situations it won't really give you good outcomes. So my advice is simply just use it to tell the direction based on your strategy. Now I'm going to mix this I'm going to mix these two indicators with my personal trading strategy so you can actually see what I personally mean. So now, talking of combining them with my personal trading strategy, here's what I'm basically going to do. Now for me, I'll be using the 20 and then the 50 moving average alongside my personal trading strategy. Why am I using the 50 and the 20 over the 200? Well, here is the basic truth. The 200 is for people who trade a higher time frame. I trade the 30-minute time frame, which means that I'm looking at the shorter trend of the market. I don't care about what is going on the higher time frame. All I need is simply what is going to happen in the next few minutes. So I trade the 30-minute, 15-minute time frame. So I'm looking at the short term. So for that reason, I'll rely on the 50 and then the 20 moving average. Now looking at it, here is it. Now let me do something here. So I basically trade break and retest, and at times I mix it with other blocks and stuff. So now let's take a look at this particular market here. So for this market is basically good. So we are on good. So now let me mark out some key levels I can see here. So here I have a support level right here. As a support, I have a resistance right at this top here. Let me adjust it. So here is a resistance level, which means based on my trading system, I should be looking for buys when market actually comes back to retest this top here. Okay. And then looking at the new market position right now, we can see that the market also just broke this particular support here. Here. You can see this was a support, the market broke it, and now it's about to use it as a resistance. So I'm just going to put my static level here. These are static support and resistance levels. Now let me make it blue and then thicker. So these are static levels. So I have a static resistance here and then a static support here. Right here. Now I trade break and retest, and I focus more on the current market position and not really this long term. Now this is an old level. So this level was formed on the 31st of August. 31st of August. And then this one here, we are currently on the 1st of September. Okay, so this is 1st of September. So now basically what I'm waiting for here is simply I'm waiting for this market to either break and retest here. That is, if it breaks and retests and then the two indicators are in line with it, I'm going to take my sell. Or if it comes back here and give me a perfect confirmation and the indicators are below it, I'm going to look for a buy. So now let me just forward it gradually. Let's go. Now you can see the 50 is already down. You can see that the 50 is down, and then the 20 is still above it, which means that what the buying momentum is not really that confirmed. I mean, the selling momentum is not 100% confirmed yet. And if you take a look at it here, you can see that the market has already come back to retest this my previous support level, that resistance level that I marked before, which means if I was focusing on my break and retest without the indicator before, I might have just taken a buy here on the lower time frame. But then let's focus on what I'm currently looking at right now, which is this level that I am observing. So now let me go. Okay, I'm going candle after candle so we don't mistake any particular point. Okay, let's go. Okay, the market has come back to retest. Now you see that it came back to retest, but then the two lines are still not in agreement yet, so I'm not going to take any trade. So I'll still leave it, and then okay, you can see it went above. Now the two candles are in agreement, so I'm waiting for a confirmation of my own setup. Now you see the two candles came into an agreement, but then I did not get the confirmation of my setup, so I wouldn't trade. But still, I know that what my break and retest is still perfectly in line, since the market is still just ranging within this particular point here. So all I need to do from here is simply adjust the resistance to this new high, and the support I'll still keep it at same level because these are just fake touches. Now I'll keep going. Now let's see what happens here. Okay, so even if I get an order block right now, I'll just mark out the other block which I haven't gotten. Okay, so you can see gradually they are coming in line. Okay, let's keep going. Okay, the 20 is coming below the 50 now. That's a good sign that the bearish momentum is winning. Okay, now the bearish momentum is finally winning. You can see that what now the 20 is sitting below. So what I'm looking for is simply waiting for this market to create an order block for me to look for a sell. Okay, now let's see if we get the other block. Okay, here we've gotten the other block here, which is this particular area here. This is our other block. Here's a big bearish momentum that took out all this low here. If you mark it right now, I don't consider the wicks, so you can see all these lows here has been swept out. This created a break of structure for us. So let me just say a break of structure was created right here. Oh, my lines are in white, so let me just change it back to blue, and I test green. So a break of structure has been created here. Here we have our other block. So now we are waiting for, and the two candles are also in line, so I'm waiting for a retest. Let's see what happens if we are going to get a retest. Okay, the market shot further down. Now I'm still waiting for my retest. So now let's see. Okay, it's going. Let's see. Okay, the wick came to tap on the 20. So the moment it tapped on the 20 here, since the 50 is above the 20, this could have been a good sell. So you could have set your entry at this 20 here, and then your stop loss, I'll say keep it above the 50 if they are in this manner, and then you aim for a 1:2 as usual. So let's see what happens here. And you could have gotten it, and then here you can see that the market is still following through on this indicator. So as long as the market is still trading alongside the indicators, one thing I advise is simply you can just set your trade to break even, and then you let it keep running as long as the indicators, until the 50 is trying to act funny. So you can still keep it running like this. You see it came back to retest the 20 again. For someone who knows how to trade this strategy, immediately came back to the 20, give you this bearish close. You could have had another trade here, and then you continue it running, and you can still keep going. You see, you keep going here, another touch again, you could have secured another entry. Now you see that I'm not relying on just the indicators, but I made my own setups so that to make sure that the market is moving according to my own setups as well. So you see, you keep going until you are actually satisfied. So guys, this is every single thing you need to know about actually trading the moving average indicator. This is everything you need to know about the moving average, and my advice is simply combine it with your own strategy. If the moving average and your strategy comes into an agreement, like for example, what I did here was that I marked my order block, wait for the 20 moving average to go below my order block, and at the same time stay above the 50 moving average. Immediately I got that confirmation, I knew that I could actually go in, and so I just went in. This same thing I advise you to do as well. Have your main strategy, and then let these two indicators come in agreement with your strategy, then you can take your trade. So as long as you have an order block, the 20 and the 50 moving average are below that order block, and then the market came to test the 20 moving average, even if it's just a week, you can actually go in, but make sure that it's not too far from your order block level, so you can always keep your stop loss above your order block, and at the same time keep it some few pips above the 50 moving average as well, because in some situation it might break your order block, break the 20, but then still end up respecting the 50, because the 50 is well known as the dynamic support or resistance indicator. So guys, hope to see you in my next video. This is every single thing you need to know. As I said, if you're looking for a reliable broker to trade with Light Finance, the link is available in the video description. If you're looking for a prop firm to trade with, I recommend Blueberry Funded. I'll be tagging all of them as well. For those watching on Facebook or TikTok, check the links in my bio or in the pinned comment. See you in my next video. Bye.